Hey there investors and welcome to our channel. Today we're going to dive into one of the most talked about and powerful companies on the planet, Exxon Mobil, XOM. In a world that constantly talks about energy transition, ESG, and the end of fossil fuels, why would anyone, in their right mind, invest in big oil? Exxon is often seen as a dinosaur from the industrial age, a relic headed for extinction, and yet, the company continues to be one of the world's biggest cash generators, paying out huge dividends and buying back tens of billions of dollars in shares. This brings us to the Exxon paradox and the main question for our video today. When will oil stop being the main energy source? And more importantly for us investors, what happens to Exxon when and if that happens? In this video we're going to take a deep dive into Exxon's strategy. We'll look at its crown jewels, its controversial low-carbon strategy, and, most importantly, we'll build a clear investment plan. And I'll give you the main idea right now. Exxon Mobil isn't betting against the energy transition. It's betting that the transition will be slow, tough, and expensive. And that, in that situation, the world will still desperately need oil and gas for decades. Exxon's idea is to be the last giant standing, the cheapest, most efficient, and most profitable producer, able to do well even when demand starts to go down. We're going to break this down into 4 parts: the profit drivers, the new crown jewels in Guyana, and the Permian Basin. The transition strategy, what Exxon is, and isn't, doing about renewable energy. The cash machine, a look at dividends, share buybacks, and financial strength. The investment idea, the bulls, the bears, and our final decision. Grab your coffee. This is going to be a lot to unpack. The new profit engines. To understand today's Exxon, you need to forget the Exxon of 10 years ago. The old Exxon made some expensive mistakes. The most notable was buying XTO Energy in 2009, a huge bet on natural gas that got crushed when prices fell. They also poured billions into oil sands in Canada, which is expensive and dirty oil to get out of the ground. These high-cost, low-return projects almost ruined the company's good name and chipped away at their competitive edge. But Exxon learned, or was forced to learn, the hard way. Today, their strategy is super focused on one thing: cheap oil barrels that make a lot of money. And this strategy has 2 names: Guyana and the Permian. Highlight 1, Guyana, the crown jewel. First, Guyana. What Exxon found there, in the Stabroek Block, is simply one of the biggest oil discoveries of this century. We're talking about more than 11 billion barrels of oil that they can get out of the ground. But the most important thing isn't how much oil there is, it's how cheap it is to get. Exxon and its partners are pulling this oil out at a break-even cost. That's the price oil needs to be for them to make their money back, of about $25 to $35 per barrel. Let me say that again. $35. In a world where Brent oil sells today for $80, $90, or even if it drops to $60, that's incredibly profitable. Exxon plans to have 8 production ships, FPSOs, there by 2030. That's huge growth. Highlight 2. The Permian, the flexible monster. Second, the Permian Basin in Texas. This is the heart of American shale oil. Unlike Guyana, which is a long-term project, the Permian is short cycle. Exxon can decide to drill a well and have oil flowing in just a few months. This gives the company a ton of flexibility. If oil prices drop, they can just stop drilling. If they go up, they can speed things up. Exxon was already big in the Permian, but their purchase of Pioneer Natural Resources in 2024 made them the undisputed king of the basin. The plan is to boost production there from 1.5 million barrels a day in 2025 to 2.3 million by 2030. Together, Guyana and the Permian account for over 70% of the company's new investments. They are the engine that should create $20 billion in profit growth by 2030. And let's not forget about downstream and chemicals. Exxon doesn't just get oil out of the ground, they refine it and turn it into plastics and chemicals. Their refineries are connected to their chemical plants, which gives them a huge cost advantage. This part of the business should add another $8 billion in profits. The main point is this: Exxon's focus on cheap oil barrels, Guyana and the Permian, makes them strong. Even if the demand for oil goes down, the high-cost producers, like oil sands, low-quality deepwater oil, etc., will be the first ones to shut down. Exxon, with its $35 a barrel costs, will be the last one standing. The transition strategy. Okay, but what about the energy transition? Isn't Exxon just ignoring the elephant in the room? Yes and no. And this is where their strategy gets really controversial and, honestly, fascinating from an investment point of view. Let's answer our main question. When will oil run out? Well, predictions vary wildly. The International Energy Agency, IEA, suggests that global oil demand could peak before 2030, driven by the adoption of electric vehicles. On the other hand, OPEC and Exxon, themselves, believe the peak is much further off, maybe not even this decade, pointing to growth in Asia, Africa, and non-fuel demand, plastics, chemicals. Exxon looked at this situation and made a different decision than its European friends, like BP or Shell. What Exxon is not doing, investing billions in renewable energy generation, like wind farms or solar farms. Their logic: we don't have a competitive edge here. Anyone can do this. Margins are low, and it's a completely different business. What Exxon is doing, it's betting on low-carbon solutions where it believes it has an engineering advantage. This comes down to three main areas. 1. Carbon capture and storage. CCUS. This is the big bet. Exxon wants to use its experience in geology and pipelines to capture CO2 from big industries, steel mills, cement factories, refineries, and permanently bury it underground. Their acquisition of Denbury in 2023 was key, giving them the largest CO2 pipeline network in the United States. Exxon isn't trying to clean up its own cars, it's trying to sell a carbon cleaning service to other industries that can't be easily electrified. 2. Hydrogen, mainly blue hydrogen, which is made from natural gas, something Exxon has plenty of, and where the emissions from production are captured, using CCUS. 3. Lithium, a newer bet. Exxon believes it can use its drilling technology to extract lithium, essential for EV batteries, from underground saltwater in existing oil fields, like in Arkansas. Exxon plans to invest $30 billion in these areas by 2030. But, here's the catch. Pochuburin Oster Sturpao. If the profits don't happen, Exxon won't invest. This is capital discipline. They aren't investing for an idea. They're investing where they see a path to profit, depending on public policy support, like tax credits, and market development. For the investment idea, this means Exxon is getting ready to make money from cleaning up heavy industry, not from consumer electrification. It's a side bet, but one that helps its main business. The cash machine. Alright, the strategy is interesting, but we're investors. We want to know about the money, and this is where Exxon shines for a certain kind of investor. 1. Strong balance sheet. During the 2020 crisis, Exxon borrowed a lot of money so it wouldn't have to cut its dividend. It was a risky move, but since then, using the extra money from higher oil prices, they've paid off that debt. Today, their net debt to capital ratio is 8%, as of mid-2025, which is incredibly low. The company is a financial fortress. 2. The dividend break-even point. This is the most important number. Exxon believes that by 2030, thanks to their low-cost projects, they can cover all their investments and pay their dividend with oil at just $30 a barrel. Think about that. It means the dividend is, theoretically, safe, even if oil prices drop by 60% or 70% from where they are now. That's security for income investors. 3. The cash return. What does Exxon do with all that leftover cash? They give it back to shareholders, in two ways. Dividends. The company is a dividend aristocrat, and even though growth was slow, it's starting to pick up again. Share buybacks. This is the big driver. Exxon is buying back $20 billion worth of shares every year. This reduces the number of shares out there, which boosts earnings per share and drives up the price of the remaining shares. Exxon today is a capital return machine. It's using the profits from its old and new assets to, essentially, pay its investors back as fast as it can. The investment thesis. Bulls versus bears. Alright, let's sum everything up into a clear investment thesis, looking at both sides of the coin. The bear case. Why avoid Exxon? 1. The execution risk. Exxon is spending a lot, planning to invest up to $33 billion a year. Its track record with big spending isn't great, remember XTO. There's a risk that the returns won't be as good as promised. 2. The stranded assets. Risk. This is the big scary one. Bears say Exxon keeps investing in long-term oil and gas projects, like LNG and some offshore projects. What if the energy transition happens much faster than they think? What if the International Energy Agency is right and demand peaks in 2030? These assets could become stranded, worthless, unable to make money. 3. The price risk. What if there's a global oversupply and oil prices drop to $50 and stay there? Exxon's profits would be much lower than expected. 4. The ESG risk. Exxon isn't exactly a darling company. The risk of lawsuits, new carbon rules, and divestment by ESG funds is real and could keep the stock price permanently lower. The bull case. Why buy Exxon? 1. The best assets. The bull case is simple. Guyana and the Permian are the best and most profitable oil assets in the world. They will generate a mountain of cash. 2. The practical transition strategy. Bulls say Exxon is being smart. Instead of burning money on renewables where it has no advantage, it's focusing on CCUS, hydrogen, and lithium, areas where its engineering and geology expertise really matters. It's betting on decarbonization, not replacement. 3. The slow transition thesis. The main argument is that the world will need oil and gas for another 30, 40, or 50 years. Electric vehicles don't solve the problem for trucks, airplanes, ships, and most importantly, the petrochemical industry, plastics. In this scenario, the lowest cost producer, Exxon, wins. 4. The capital return machine. At the end of the day, you're buying a company with a strong balance sheet, a secure dividend even with oil at $30 a barrel, and one that's returning $20 billion a year to shareholders through buybacks. Final verdict. So, what's our investment idea for Exxon Mobil? Investing in Exxon Mobil in 2025 isn't about finding more oil, it's a bet on the end game of oil. You're betting that the energy change will be, as CEO Darren Woods said, an emissions management transition, not an energy source replacement transition. The idea is that, for many years, the world will still need oil, and Exxon, with its super low costs in Guyana and the Permian, will be the company best set up to provide that oil and make money doing it. You're buying a strong company that's using the huge profits from its main businesses to pay you well today, dividends and buying back shares. Build the next business, CCUS and lithium, that can do well in the next part of the industrial economy. Is it a debated investment? Absolutely. Does it carry a huge long-term risk if the change happens fast? No doubt. But for the investor who believes that reducing carbon will be a slow and difficult process, and who wants income and money back now, Exxon has set itself up to be the last and most profitable oil giant standing. But what about you? What do you think? Is Exxon a dinosaur waiting for the asteroid, or a predator adapting to the new world? Leave your thoughts in the comments below. And of course, this isn't investment advice. Do your own research. Thanks for watching, and see you next time.